Munzer Ghosheh here with you today from the Entrust Group. I'll be your co-presenter. I'm excited to have as my guest speaker David Coe, the founder of Freedom Growth. He will shortly share with us his insight and expertise on real estate trends and strategies. So welcome, David, and thanks for joining us today.
Good to be here.
Great. We're happy to have you with us. So again, thank you all for taking time out of your busy schedules to be with us. We hope that you'll find this presentation to be informative for you. This will be a kind of a two-part presentation where I will start by briefly talking about self-directed retirement plans kind of in general and real estate IRA in specific. After which I'll hand the mic to Dave for his part of the presentation. I'm sure along the way that a lot of you will have some questions for both of us. So what I would like to do is I encourage you to go ahead and type these questions in the chat box as you see there below, and we'll try to get to all of them towards the end of the webinar. So here's our disclaimer that we're actually required to read out loud to you. The Entrust Group, Entrust, does not provide investment advice or endorse any products. All information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering any type of investment. So a little bit about our firm, the Entrust Group. For those of you that are not familiar with us, we're the premier provider of self-directed retirement plans. We work with individuals and small business owners that wish to invest in alternative, non-traditional investments when it comes to their IRAs or 401k plans. We don't provide investments or advice. We simply do the record keeping and administrative work for your self-directed retirement plan and provide you with the education. You identify the investment you wish to make, and Entrust will purchase that for you, administer the asset for your IRA. That's basically what we do. We're the leaders in our industry. We've been in business. We actually celebrated our 33-year anniversary a couple of weeks ago. Been in service, processing almost 15,000 client transactions on a monthly basis, and managing nearly about $4 billion in investor assets. So a little bit about our agenda today. Again, I'll start by talking a bit about the real estate IRA. What are the investment options and strategies available to you out there? Touch up on some rules and regulations, then hand it over again to David for his Freedom Growth presentation, and then we'll open it up for Q&A for our listeners out there. So to start here, a real estate IRA, and I'm sure many of you have heard this term out there. It's an IRA that invests in real estate. Very simple. It's not a type of IRA, just a term that is used frequently in the industry. You see, you as an individual have complete control over selecting your investments when it comes to a truly self-directed retirement plan. So you can buy, among other things, real estate and hold it inside your retirement plan. The issue is that the vast majority, there's about $6 trillion held in individual retirement accounts. They're invested by banks and custodians in Wall Street type of investments. And most of these investors are unaware of their other options out there. You know, the options to invest in alternative assets such as real estate and other allowable assets out there. But I think recently more and more people are becoming more aware of the possibility to truly diversify their investments through a self-directed retirement plan like the ones that are offered by the Entrust Group, that again allows you to invest in all types of assets, including real estate. So what are the benefits of using an IRA to invest in real estate? First and foremost, I believe you are taking control of your own retirement dollars by investing in what you know and understand. So if you're out there and you are a real estate investor and have done so outside of your retirement plan, been successful at it for many years, chances are that's what you want to do when it comes to your retirement plan. Invest in what you know and understand. You make your own investment choices rather than having someone else tell you what to invest in or what's good for you. So you're investing in what you know again. But I also believe just as importantly is the aspect of diversification, fully diversifying. So again, a self-directed retirement plan allows you the ability to fully diversify your portfolio and help mitigate the risks by investing in different types of plans out there. So what are the investment options? What can I invest in when it comes to my retirement plan? Again, a self-directed retirement plan will allow you much greater flexibility in the investment choices that you have. So our clients, for instance, at Entrust, use us to invest in all types of investments, including, just to name some, precious metals, LLCs, limited partnerships, oil and gas projects, notes, trustees, etc. But by far, our most popular asset is real estate, and in all types, whether it's residential, commercial, international, offshore, raw land. Many of our clients just purchase raw land and hold it in their IRAs. Any type of real estate asset can be held in your retirement plan, condominiums, apartments, etc. So what are the investment strategies, and obviously David will touch up on that as well, and funding options that we see. We typically see IRA investors utilizing the same strategies when it comes to purchasing real estate with their IRA funds that they do with their personal funds. So namely, they would either purchase a direct purchase, which is cash only. They would go into partnerships or joint ventures with others, other IRAs or other people. They would do it through a single member LLC, or as some call it, an IRA LLC. Or they would invest through a private REIT or syndication or real estate fund. I mean, those are really the investment strategies out there. And again, David will talk in greater details about that. But let me kind of go ahead and discuss these funding options in a bit more detail for you for just a minute. And again, we won't spend too much time on them. But the first option, funding option, is cash, which is a direct purchase. This is where the IRA goes into contract to buy the property 100%. So it's 100% paid cash. It's probably the simplest and quickest way where the title is held in the name of the retirement plan. For instance, the Entrust Group for the benefit of your name and IRA number. Entrust signs a purchase agreement and the documents. And in this case, all the rents, expenses flow in and out of the IRA. Again, very simple, straightforward. Another funding option would be partnering, where the real estate IRA can partner with another IRA, your personal funds, or other people's funds. So this is done as an undivided interest joint tenants, where ownership is proportionate to the investment percentage for each. And again, the incomes and expenses are based on obviously on the owner percentages there. That might be a good strategy, for instance, for a larger deal. You might want to purchase, for instance, a commercial property, or the family wants to go in and buy an apartment building, where you're partnering with other people's, your other personal funds or other IRAs and so on. Single member LLC, and again, David will talk about this quite a bit, but another popular funding option where the IRA invests in the LLC by acquiring its member shares. Very simple. And then this would allow you immediate access to the funds and maybe possibly limited liability protection from claims. But we see a lot of our clients going towards that route when it comes to funding option. Lastly, some of our clients choose the option to leverage when it comes to a real estate strategy. This could get tricky, as the most important thing you want to remember is to think of yourself and your IRA as two separate entities. So your IRA will put the down payment, but the IRA as an entity will apply for the loan. And what the IRS stipulates is that the loan must be a non-recourse, which means basically that the lender can only go after the property in case of a default. So the lender cannot use the IRA holders, for instance, income, credit, or employment to facilitate that loan. So again, it's not your typical traditional loan out there, and the most important thing to remember is you and your IRA are two separate entities, and the IRA is applying for the loan, not yourself. But having said that, that should be a valid strategy for all when considering purchasing real estate with IRA funds, just as direct purchase is, partnering, or through the LLC. But as with anything else, please consult with your attorney and or CPA before entering into any type of transaction. So investment restrictions here. These are the investments that are disallowed. In other words, your IRA may not purchase. And the Internal Revenue Code 4975 specifically states that a retirement plan may not invest in collectibles, life insurance products, or S corps. Anything else you may. So, including real estate, as we mentioned, and other investments that we mentioned earlier. So again, you just need to work with an administrator that will allow you the flexibility to fully self-direct, like the Entrust Group. So just to go back quickly on the IRA purchasing, the real estate, and the titling, and the cash flow, etc. It's important again to understand that the IRA, not you personally, is buying the property. So therefore, the title is to be held in the name of the Entrust Group for the benefit of, for instance, John Smith, IRA number 12345. So unless obviously you wish to set up the LLC and go that route, in which case escrow is opened in the name of the LLC and the title is held in the name of the LLC. But in the case of the IRA purchasing it, again, cash flow in and out of the IRA. So the incomes, such as rents, are paid to the IRA. Expenses, such as repairs, are paid out of the IRA. So due diligence here is key. Clients very often ask us and come to us and say, what could go wrong, or what are the disadvantages or pitfalls of self-directing? And typically I say the only thing I can see is lack of knowledge or lack of doing your own due diligence. So make sure you're working with a reputable and experienced IRA administrator that's been around for many, many years. Again, we've been around for over 30 years here. Align yourself with good, knowledgeable professionals for advice. Again, we always say we're just one part of the Rolodex. So you want to make sure that you have a real estate agent that's familiar with IRA investing or well-versed on this, a CPA that understands the rules and regulations, attorney to also get advice from. Because keep in mind, we are just the administrator here, and we cannot give you any sort of advice, whether it's legal or tax advice. So very quickly, we've discussed in the past 15 minutes or so the real estate IRA. We talked about benefits of investing in real estate using IRA funds, different strategies, funding methods, and so on. But what you want to be aware of is, however, is the IRS may allow you to invest in real estate, but with restrictions. First and foremost, it has to be, the property has to be for investment only. Arm's length transaction, no self-dealing. For instance, you may not purchase a property in your IRA and live in it, or run a business out of it. That's a question we always get all the time. You may not do any work, repairs to the property yourself, or manage the property itself. This also applies to what we call disqualified persons, and they're listed here, which is basically direct family members. Your spouse, parents, grandparents, children, grandchildren. So anyone that's related to you directly up or down is deemed to be a disqualified person to your IRA. And again, the Internal Revenue Code 4975 states that any transaction between your IRA and a disqualified person is a prohibited transaction. And if you engage in a prohibited transaction, such as renting to a daughter or buying property from your father, etc., your IRA is disqualified and is distributed to you, and you end up paying the penalties and the taxes on it. So really, in short, what we're trying to say is stay away from all disqualified persons and make sure that the deal is at arm's length and there's no self-dealing here. So establishing a real estate IRA, which is really, again, it's a term, not a type. It's like establishing any type of IRA with us. It's 3 steps. Opening up an Entrust account, which typically takes about a day or 2 by filling out very simple paperwork for us. We get the account set up for you. You fund your account, whether it's through a transfer from a current IRA that you have or rollover of previous 401k funds. Typically that takes about 10 days to 14 days. And then you're ready to invest, ready to identify the property, ready to identify the real estate property you want to invest in. Direct us to do so. We coordinate with escrow. We fund escrow, we close escrow, and now the IRA owns the property. It's really that simple. So in summary, we talked about the lots of options here that what your IRA can invest in. Again, virtually any kind of real estate, residential, commercial, raw land, offshore, any type. Many ways to invest, whether it's direct purchase, cash only, partnering, undivided interest, setting up the single member LLC and going that route, or leveraging your IRA, again, through a non-recourse loan. Please remember the due diligence is key here to make sure that you do your own research when it comes to everything that has to do with your retirement account and align yourself with good advisors for you. So with that, what I'm going to do is hand over the mic for David Coe here for his part of the presentation.
Very good, Munzer. I trust you can hear me okay?
Yes.
Okay, good. Well, hi, everyone. Thanks for spending some time. And, Munzer, thanks for walking everyone through on the self-directed side. As Munzer said, there's a couple of things that I'm going to talk about today that are a little similar to what Munzer covered. Just to help you understand who I am and how I'm different than Entrust. You know, whereas Entrust is a custodian, they actually hold your money. I am strictly an advisor. I'm a real estate advisor. I carry a California real estate license, and I help people navigate the self-directed IRA waters, in particular on real estate and different kinds of real estate transaction. Freedom Growth is a company that basically does just that. We do get involved in some structures. Munzer mentioned the special purpose LLC and some of the solo case stuff, which is something we're going to touch on today later on. But we also get involved in passive real estate investing through Freedom Growth. I am a local realtor. I run a team in the South Bay of Los Angeles, which is basically everything south of LAX. And then I also run a real estate investment club in Manhattan Beach called FIBI. And if anyone happens to be in LA, we're actually meeting tonight at the Manhattan Country Club. So if you're interested, send me an email and I'll get you the information. The first part of my presentation is I wanted to give a little bit of an overview of where the market is right now, and please take this with a grain of salt. I'm just one person. This is my opinion. And I also think that this particular topic, we could spend an hour talking just about this. So I tried to condense this down into 2 slides. So here are my two slides on where I see the market right now, the real estate market in particular. It is recovering. Now, it's a fragile recovery, and when we talk about that, there's a lot of factors that are helping drive this recovery right now that we feel are unsustainable. So, for example, right now there's a lot more demand than there is supply, which is the number one signal for it being a seller's market. But that's happening for a couple of different reasons. Number one, there's been a huge influx of institutional investors. I'm sure all of you have heard of different private equity groups or real estate investment trusts, just private hedge funds that are coming in and buying real estate. That's pulled back a little bit than maybe a year ago, but it was still driving a lot of the steep recovery that we had in the last couple of years. We've also had an influx of foreign capital, which you can say we always do, but I think there's some countries in particular that are concerned about their economies and looking to shelter revenue in other countries. And the United States and London seem to be really big recipients of that. I think other than the number one market being London, the next four top markets for institutional investors are LA, Chicago, New York, and San Francisco. So that probably doesn't come as much of a surprise, but there's been a lot of foreign capital in our market and other markets as well. And then, of course, there's a lot of pent-up demand. Once you got past 2008, 2009, 2010, there were a lot of people that were trying to get back into the real estate market but couldn't for various reasons. All of a sudden, some credit started opening up, and 2011, 2012 is really, actually 2012, 2013 is really when we started seeing a lot of that demand come to the market. We've also had what we like to call suppressed supply, and a great article, if you don't read, I recommend you read a blog called Zero Hedge. It's a really good blog. If you look on Zero Hedge and you search up the term foreclosure stuffing, there's a great article on how a lot of the banks were restricting the number of foreclosures that should be hitting an individual market. And a lot of it had to do with some of the issues banks were having on robo-signings and some of the reaction they had to that. But even today, even after there's a settlement, we're still way below where we should be on foreclosure industry in the market. And there's some really good numbers if you want to check out that article. We've also had some really artificial low rates. So we've had, because of some of our government's involvement in the economy, keeping the rates down low, it's been a great time to get a loan on a piece of property. So our advice is to proceed cautiously. Yeah, we have had a recovery. It is recovering. But again, there are some things that are some strong headwinds that are out there. Number one, credit is really tight. It's hard to get a loan. If you look at in 2013, the average credit score of a buyer was 750 points. That's about 50 points higher than the average consumer. And ironically enough, it's about 50 points higher where the average was in 2003. So 750 is the average, right? So if you think about that, it's really hard to get a loan these days. Dodd-Frank was a major piece of legislation it's been enacted the last couple of years. The majority of it really hit in 2013, 2014. That piece of registration has also hampered the ability for people to get loans. And then even still, rates are rising. We've already seen an easing on our QE3 program where the government's buying less bonds. They're injecting less capital into the economy. And as that continues to taper down, the theory is that rates will kind of continue to tick up. And then supply is rising. A lot of the reasons why supply was being artificially suppressed before are starting to go away. A lot of sellers beyond, in 2010 that were below what their home was worth are now above, and they can do a standard sale versus a disclosed sale, or a distressed sale. There's also a lot of new construction. And on the graph here, these are the housing starts for the last 30, 40 years in real estate. And you can see a housing start is a new piece of construction, right? A new home that's being built. We are way below where we are historically in our country, and we're in a pretty steep upward trend here. So that's kind of my overview of the market. I still think real estate is a great place to invest, but you do have some things that you have to be concerned with. One of the things that we talk a lot about, and really the rest of my presentation is going to be about investing passively in real estate. And even more in particular, it's about building a passive real estate portfolio. Here are some benefits if you have a real estate portfolio. Number one, you have diversification. If you're able to take money and spread it out into multiple different kinds of deals, you have diversity, which is really, diversity is the only way I think you can truly mitigate risk. And even then, you can't mitigate risk. It's always going to be there. But the best way to reduce risk to as much as possible is to spread it out in a portfolio kind of environment. And I think diversity also has to do with where you invest in real estate, looking at different markets, different kinds of asset types, and different time commitments. Some real estates are better when they're short-term. Some are better when they're long-term. Having a mix of that in your portfolio offers you opportunity, when you need to make a move in your portfolio. Part of amortizing that risk is you can also build a portfolio in preparation for a moment in the cycle, right? So I think a lot of people believe that there is a downturn out there. No one knows if it's in the next year or the next 7 years, but real estate, like all markets, is cyclical, and at some point there will be a downturn. And there's ways you can use a portfolio to prepare for that, at least for part of your portfolio. And you can make real estate portfolios self-sustaining. One of the best things about a real estate portfolio is if it's generating income, you can use that income to help support the remainder of your portfolio, or perhaps different pieces of real estate or development that don't necessarily have income, they just have expense. And the best thing about building a portfolio is that it's personalized. Okay, there's no such thing as a perfect investment. Every investment has a flaw. And the trick as an investor is understanding where that flaw is, what you think the risk of that flaw becoming a reality is, and most importantly, is it a risk that you're willing to take? Because if it is, then it's a good investment. If it isn't, it's a bad investment. I think you can also generate a predictable cash flow when you have a portfolio, because again, you have multiple pieces of that engine that are generating income at different points in time, and they can be passive. And we'll talk more about passive here in a second. Some benefits of real estate in general. Number one, real estate is a long-term investment. In general, it is. And especially when we start talking in an environment about IRAs, IRAs are long-term savings accounts. So I really like the way those two things align. Number two is real estate has multiple ways that you can make money. You can make money on cash flow. You can make money on appreciation. You can make money on debt service, having someone else buy down your loan. You can also make money on taxes. Now, when you're in an IRA, you don't always get that last benefit because you're already in a tax-free environment. But you still get 3 other benefits of owning real estate, and that's more than most asset classes allow. Real estate can help to reduce your taxes. And again, if you're using it outside of your IRA, there's some huge tax benefits to investing in real estate. On number 4, I like to say that while all markets are cyclical, real estate tends to be a little slower moving. It doesn't happen as suddenly, and if you're paying attention, you can keep an eye on where it's going and react accordingly. And then lastly, you have control over real estate. One of the biggest things that we like about real estate is that no matter what happens, there's some level of control that you can exert on that piece of property, or to improve it or to re-rent it or whatever the situation may be. All right, I've got a couple of key takeaways today. Number 1 is you can't invest money you don't have. The way you start becoming a successful real estate investor is by saving. Now, that doesn't mean you can't invest in real estate if you don't have money. There's another really important part of investing in real estate, and that's time. So if you had no money but you had time, there's certainly ways you can get started. But the only way you can invest passively in real estate is if you have some money to invest. So that's the number 1 step to investing in real estate. There's all kinds of passive real estate investments. Munzer mentioned a couple in his presentation earlier, so some of this may be a little redundant, but there are turnkey rentals out there. And when I say turnkey, it could be single family, it could be multifamily, but usually there's a property manager out in front of you or your IRA, whatever is making the investment, that is running all the day-to-day. You can invest passively in real estate notes. And again, this is a type of investment where you might want to buy a loan. Someone has made a loan and you want to buy that loan. There are ways you can do that. And then you can put a servicer out in front, which is almost like a property manager for a loan. And they're the ones that collect the money from whoever the borrower is and get you your money. There are syndicated real estate deals. Basically what a syndicated real estate deal means is there's an operator or a company that is making a real estate investment, and they're raising money from private investors, and sometimes institutional investors as well. And then they're on the front line. They're the ones that handle the business of running that investment. The investor is just a passive participant in that investment. And then there are joint ventures. There's all kinds of ways you can joint venture with someone else. I always say joint venture up. It's always better to partner with someone who's more sophisticated than you are. It's a great way to learn. But certainly there are reasons why you might want to joint venture down, depending on the situation. Here's some typical syndicated asset types. These are all different asset types that in some way, somehow we've either looked at or been involved in the last couple of years. Certainly on residential, there are some residential funds out there that are buying multiple properties. Retail, office space, multifamily, mobile home parks are becoming increasingly more popular, and one of the things that we like as a downturn hedge. Same thing with self-storage. When times are tough, people tend to rent mobile homes and other low-income housing and self-storage facilities as well. And senior housing is another kind of structure. And there's probably 50 others that aren't on this slide, but I think this is a good, a good sampling of what kind of syndicated assets might be out there. Our number 2 takeaway for today is who you invest with matters almost as much as what you invest in. Okay, especially if you're going to be passive. When you start investing this way, who's on the other end of that deal, who's the person that you are entrusting your funds to, is almost as important as what the actual asset is. And one of the things that we like to tell our clients is that making a bad deal with good people will generally go better than making a good deal with bad people. Ultimately, when you invest, you're taking a risk, you're betting on a person or a company, so make sure you spend as much time looking at them as you do at the deal. When you're looking at any kind of investment, due diligence is key. Number 1, we always like to look at who the operator is, what kind of experience do they have, how long have they been doing it, how have they performed over time. We always like to run background checks on people just to see if there's anything in there. And then we like referrals. We like talking to previous clients. We like talking to other advisors, people they've done business with. It's good to hear. And sometimes their banker, just understanding what kind of relationship they have with their banker. You have to look at the merits of the investment. And some of the things that we always like to look at is, are the returns relative to risk? What that means is it's okay if you take a high-risk investment as long as the returns warrant that. What you don't want to do is make a high-risk investment for a low-return opportunity. So you want to make sure that what your expected payout is worth the risk that you're taking. We always like to see an investment to make sure that they conservatively project out and they're not being overly aggressive in what they, how they're developing their returns, their projected returns. And we look for downside protection. If something did happen, what kind of risk does that create, and what's the process of having to deal with whatever that problem may be. We also look at deal structure. Is it fairly split with investors? And again, almost like looking at risk, if you're going to take a risk but they're getting the majority of the return and it's not fair to you, then that may not be a good deal to be invested in. We want to make sure they're incentivized to perform. Whoever the person who's handling the day-to-day, we like them to have some skin in the game, or certainly have the majority of their benefit come when the majority of your benefit would come as well. And looking at exit strategies. How are they structured? What are they going to do? When does it end? How does it end? And do they have multiple ways of ending it just in case? We're going to kind of move into some case studies. I've got a couple of just generic examples of previous clients we've worked with that have in particular used their IRAs and 401ks to invest in real estate, majority of them passively. Case study 1, we have a client who's in his late 40s. He had an old 401k plan. He was looking to take that money and put it into real estate. He wanted cash flow. He wanted growth. He was still young. And I say 47 is still young because that's about how old I am. So I still believe I'm young. So therefore Jim is young as well. And he wants to be moderately passive. He doesn't want to have, he's still working full time. He doesn't want to spend a lot of time running a real estate investment. And he was willing to leverage, which, by the way, in case you don't know, IRAs can borrow money. This was with Jim's situation. He had an old 401k that had been rolled into an IRA, about $200,000 into it. He wanted to keep some of that in the market, so he pulled 85 out. He put it into a self-directed IRA custodian like Entrust, and then he took that money and he bought a rental house, which he did leverage up. So that $55,000 was his investment amount. He got a loan for the remainder, and he also bought a share in a self-storage investment. He still keeps some money in the account, $5,000, which you have to do when you own rental property, because you never know when you own an asset like that where, what the next or first expense is going to be. So you want to make sure you have, adequate reserves for that deal. And also, I always like to tell people, you can invest in real estate, leverage real estate using your IRA, but there are a couple of obstacles to that, and you have to be very, very aware of those. Munzer mentioned the fact that it has to be a non-recourse loan, and I know someone asked a question. We'll get to questions, I think, here in a couple of minutes. But you also have to find someone willing to give you that loan, which can be a little more challenging than it sounds. And then, more importantly, there could be some tax ramifications if you do leverage up a real estate deal. So, but this particular portfolio was what Jim was looking to invest in. Our second case study is actually a couple. They recently retired. Barbara worked for a large medical company. Bill worked for an auto dealership. Barbara had a pension, and she was able to get a lump sum distribution, which is something that some, if not most, pensions allow. So instead of taking your pension payment, you can take it up front. And then they were also looking for cash flow and capital preservation. This was their retirement. They were ready to use this money to start living off of. And they wanted to be completely passive because they're retired. What they both did is opened up a self-directed IRA and then rolled their respective monies into those self-directed IRAs. And then they created an LLC. And Munzer mentioned what an LLC is. I have here the initial SP LLC in the logo. That stands for Special Purpose LLC, which is really what this is. And then both of their IRAs bought shares of that LLC. And now the LLC is the entity that they use to make their investments. They have a separate bank account. They make investments in the name of the LLC. They have a bank account, so they can write checks. They can wire funds. They can, in some instances, there are reasons to use a debit card. You can't get a credit card, but you can get a debit card. And I believe even there's ways within Entrust you can do something like that. So if that's something that you are an Entrust client and that will somehow help the success of your investment, having that kind of liquidity, certainly there are multiple ways you can do that beyond just setting up an LLC. And the IRA owner is the manager. So while the IRA itself is the member, the IRA owns it. In this particular instance, the wife was the primary person responsible for the LLC. So this is how this transaction looked. There was a pension plan. All of it the money got put into a self-directed IRA. Then the majority of that got rolled into the special purpose LLC, and we also had another retirement account that also went into the LLC, but it was too much for one slide. And then some money stayed behind in the self-directed custodian for other kinds of investing. The LLC was strictly for real estate, and this real estate bought a portfolio over time. They bought a real estate note. They bought into a note fund. They bought into a mobile home park fund. They bought into a multifamily deal, and they also bought shares of a retail center. So this particular portfolio is what they created, and now that generates income, which then flows back into the LLC. It's distributed back to the IRA, and then they can withdraw that money from their self-directed IRA. The third case study are a couple of mid-50s couple. Gabby was a realtor. Michael was an attorney. Both of them are just hitting their prime. They're both making good money in their careers. Gabby's been self-employed forever because she's a realtor. And Michael has been a long-term employee at a firm, but he recently started his own practice, so he decided to go into business for himself. Both of them had retirement funds. They wanted to limit their exposure to the stock market, especially Gabby because she's a realtor. They also had 2 kids in college. What they basically created is a individual 401k plan. And with the individual 401k plan, they took some money and they created this, took it out of an old 401k, created an individual 401k plan, and the individual 401k plan bought a portfolio of investments. They bought a note, they bought shares in a multifamily deal, a retail center, and a mobile home park fund. So there are a lot of advantages to investing passively in real estate. Number one, it allows for diversification. And one of the biggest things that I like about it is that instead of having to invest in a $2.8 million building and come up with all of that money, is you can take a smaller share passively and invest into it. And then take your other capital and spread it out into multiple investments, which is a hedge against a downturn. It can be a hedge against a lot of different things depending on whatever you're trying to create with your portfolio. It's easier for part-time investors. And what I always tell people is investing in real estate passively is a lot of work up front. You have to do the due diligence. You have to analyze the deal. You have to be comfortable with what the deal is doing. But once you sign the check or authorize the investment or whatever the process is, you don't have day-to-day involvement. You certainly have responsibility. There's things that you need to be paying attention to. If it's rental property, there's certainly things you have to be paying attention to. You still have to manage your property manager. But for the most part, someone else is responsible for all the day-to-day activities of that portfolio. I also like the fact that when you invest passively, you can leverage other people's experience. I like to think of myself as a pretty smart guy, but I think there's a lot of other people that are far smarter than I out there. So if someone's an expert in a certain kind of investment, instead of me having to learn that kind of expertise, I'd rather leverage their expertise and usually their credit. Usually when they're good, they can get access to better credit than I ever could on my own. So there's an advantage of even though I'm sharing some of the return with them, sometimes I can get a similar, if not a better return and take a lot less risk on my own side. And that's one thing that we talk about in that. There's a chance for significant returns, less work, and the work is front-loaded. There's also risk, just like in every investment, but again, it's a matter of balancing out that risk-to-reward ratio when you start looking at a deal. I also like to think that passive investing can somewhat reduce volatility, right? Because there's once you get your portfolio built and you're passive in it, generally there's a certain pattern that it develops, and you can start predicting that and making decisions in life off of that. And you can use your retirement funds. You absolutely can use IRAs and 401ks and pensions and different kinds of accounts to invest passively in real estate. I tell people it's actually more geared towards passive investing. I think when you get inside of an IRA, the more active you get with that money, the more complicated it becomes. Passive tends to have a lot less rough parts and a lot less friction, and makes investing passively in real estate a good fit for an IRA or for a 401k. So here are some keys that I see to a successful portfolio. Number one, know yourself. The portfolio for me is different than the one for you. It's different than the one for your neighbor. It's different than the one for your daughter or your mother, or whoever it may be. Make sure you understand what you want this portfolio to achieve, how you want it to operate, and that's what you need to build. That becomes your blueprint that you then go and build whatever the structure is. The other way you can do it is you have to look at deals. And if you're not in a situation right now where you have good deal flow, then you're not working at it hard enough. Find real estate investment clubs, network with other investors, however you want to do that, or find an advisor. Find someone that can feed you opportunities, because ultimately the best way you can learn about this is to read actual investments. And the more you can actually read, you'll start to get a sense of what is a high rate of return, what is a low rate of return. You get a sense for what is an acceptable split with the operator versus an unacceptable split with the operator. Things like that start to become clearer once you have multiple deals that you've looked at. Your job is to analyze the deal. And the way you analyze a deal is you ask questions. You read things, you think about them, and then you ask questions that you have about whatever you interpret that to be. Once the deal happens, it's up to you to track the performance. We just had a client of ours that had a couple of investments, and it looked like for 2013 the returns were really low. Well, we went back and looked at it, and turns out there was a check missing. They missed a quarterly payment. The check was sent, but it was never cashed. So, make sure that you're keeping track of when things arise, when things are supposed to arrive, and make sure, if it doesn't, make sure you send an email or ask a question just so, if there was a mistake, it can be corrected. And then optimize and adjust. None of us stay the same throughout the course of our lives. So over time, you have to make sure that your plan, whatever your goals are, as they are changing, the investments are changing as well. And that's something that's terribly important as you have this portfolio. My last takeaway is, as an investor, your job is not to chase returns. It's to pursue sanity. Right? No one wants to be in a really, really high-risk investment if they are risk-adverse. It doesn't matter what kind of returns you can get on the money. If the process of earning them is heart-wrenching to you, it's a bad investment to be in. Know what you can take, know what kind of expectations you have, and make sure that's where you're building your portfolio. Build your mental health first, then worry about your financial health. So that is all I have for today. Thank you for hanging out. I don't think I lost anybody, as I've been keeping an eye on the participants. If you have any questions, if you need additional help, if you want to network, I'm a huge believer in networking. Here's my email address. It's david@freedomgrowth.com. You can also check out our website at freedomgrowth.com as well for some more information. So with that, Munzer, I appreciate the time, and I know you wanted to open up for some time for questions.
Yes, thank you, David. I think that was some great information out there, and I'm sure everybody's appreciated that. Just one thing I wanted to clarify real quick. I think David mentioned that right at the beginning, that Entrust is a custodian, but just kind of to clarify, we're just an administrator. We're not a custodian. What we do is we work with custodians that delegate administrative responsibilities to Entrust. So we're just an agent to a custodian, just to kind of clarify that. We do have a couple questions here. We have about 10 minutes or so let's go through them real quick. So the first one, Rakesh Patel, is please define a non-recourse loan, and I think I touched up on this, so did David. It's basically a non-recourse loan is a loan that the lender has no recourse but the property. That's very simple. So in the case of deficiency, the lender cannot go after anything but the property. With the IRA, it also stipulates that the lender cannot use the IRA holder's income, credit, or employment to facilitate the loan, which means the IRA holder cannot guarantee the loan. So as David mentioned, one of your bigger obstacles out there is finding a lender that understands this. Obviously, if you walk into a B of A or Wells or Chase, they're not going to do it. So we do have a list of non-recourse lenders. Again, we do not work with anyone. That's just a list that was compiled by some of our clients that have used them in the past. You can just Google, if you like, non-recourse lenders, and you get quite a few. If you want the list, please send me an email. Be happy to forward that to you. But again, it's finding the lender is the biggest obstacle out there. Any other comments on that, David, as far as non-recourse that you've seen in your experience?
Yeah, I think just in a nutshell, a non-recourse loan is a hard money loan. Mm-hmm. And as everyone knows, hard money loans are easy to get, but the rates are higher. So make sure you understand the terms when you start looking at a deal. Make sure you understand what the lending terms are, and the deal still pencils out. And a lot of times where people have said they want to buy this deal, they use traditional lending rates, they do the whole deal, then they say, oh, now I want to invest and use my IRA. Well, that's a totally different deal because the loan is different. So make sure you understand the terms that you're looking at from a hard money loan.
Good point. Ed Ramos has a question. Are in-laws a disqualified person? Yes, they are. Again, you should not be dealing with anyone that's directly related to you. In-laws, whether they're mother-in-law, father-in-law, son-in-law, daughter-in-law, they're all disqualified persons. Anthony Robinson is asking, can you rent to a sibling, and can that sibling sublet if they want to anyone else? Well, a sibling, ironically, is not a disqualified person, but when dealing with siblings, I would deal with them with caution, meaning deal with them as if you're dealing with a third party. So if you're renting a fair market, sell to fair market and all that. The question is, can they sublet? Well, who are they leasing to? If they're leasing back to a disqualified person, which is your daughter, then obviously not. So as long as they're also dealing with third parties, I don't see any issue there. Jared Fredlick had a question. Would an LLC manager who has checkbook control be considered an IRA fiduciary? Well, we talked about this, David and I, that you can set up a single member LLC, in essence, where the LLC is set up and the IRA buys a membership. It'll be a special purpose single member LLC, and the IRA holder could be the manager. You could do that if you want, sure. But again, make sure that you're aware that all the rules that apply to an IRA would apply to an LLC that's owned by the IRA. So you want to make sure that you're aware of that. Jared also has a question for me as far as what are the administrative fees to have Entrust transfer funds from the IRA to the business checking account when using an LLC, an IRA LLC. Keep in mind, Jared, that obviously we do not set up the LLCs. David mentioned that they do that. He might comment on that. But as far as our fees, the LLC is considered as one asset. So in this case, your fees are just a $50 setup fee, $95 one-time fee to fund the asset, and about $300 a year to hold the asset. Very simple. As far as creating the LLC itself, there are obviously costs associated with that, and if you want more information, maybe you want to talk to David separately on this. But any comment on that, David, or?
Yeah, I think there's certainly, just so I understand the fees, there is a fee to set up the entity. This is the kind of entity you want to have an attorney set up. I'll recommend that you don't go to find an operating agreement online, and then there's going to be a fee potentially for the state. Depending on which state you set it up in, each state has fees that you need to be aware of as well. But yeah, if there's more specific questions on that, my email's on here. If someone sends me an email, I can send you a pricing sheet on the LLC and get you some specifics on a pricing structure.
Great. Anthony has a question. Can we get a copy of the presentation? Absolutely. Well, a couple things. I mean, all our webinars are archived. If you go to our website, and starting tomorrow, if you want to listen to this again, you may. If you want just a particular copy of the presentation, send me an email. I'll be happy to send that to you as well. And Rakesh is asking, can you repeat David's email? David, please go ahead just one more time. Give us all your contact information if you don't mind.
Yeah, no problem. It's david@freedomgrowth.com, and I did type it on the response there. So it's david@freedomgrowth.com. Great.
And Jared, one last question here before we're done is, does Entrust administer solo Ks? Absolutely, individual Ks we call them. If you want more information about that and about anything to do with self-directed IRAs, my information is right there right now. It's my phone number, direct number is 310-496-4216. My email, as you can see, is mghosheh, mghosheh @theentrustgroup.com. So with that, we'll conclude our webinar for today. I want to thank again my special guest and good friend David here for joining us. Hope everyone out there found this webinar to be informative, educational for them. And again, for any questions about self-directed IRAs, please feel free to call me. Any questions for David, again, either call him or email him as well. So thank you all for joining us, and thank you, David, again, and hope everyone have a great day. Thank you so much.
Thank you, Munzer.